Hello and welcome to Investment Ki Paathshala. At DT Now, we've been championing the simple cause of mutual funds. We've believed, endorsed, and maintained that in order to reach financial freedom, the first baby step you should take is to invest in mutual funds. Asset allocation is important, but asset allocation can be beautifully planned with simple things like systematic investment plan. Yes, I'm not saying anything new, but sometimes simple things have to be repeated again and again. In Investment Ki Paathshala, we'll try and break and demystify some very basic myths which in a sense have really haunted investors who plan long term, but why do they always think short term? So to talk about the concerns, the filters, the checks and the balances, and also the India opportunity, I'm now joined by Mr. Kailash Kulkarni and Sumendra Lahiri of L&T AMC. Gentlemen, thank you for joining us. Kailash, easier said than done, right? We talk long term, but when you see a gut-wrenching fall in small and mid-cap stocks, when you suddenly see that last 3-5 years SIPs are not giving market-beating returns or even giving flat returns, you start questioning the purpose of long-term planning.
No, absolutely right. I think we need to understand two things that, like you said, simple messages need to be repeated often, repeated repeatedly, continuously. And only it's then that people get the message and they experience it. Now, if you don't go too far back in time, but if you look at 2010 to 2013, if somebody had been doing a SIP in that period, most of the SIPs were giving just abysmal 1% or 2% return in that time. But one good year of FY14, FY15, and all those SIPs were in the high teens in terms of the return. That's because you had accumulated low. Now those people who have gone through that phase in 2010 to 2013 have actually been the ones who have stuck around this time, although it's 2.5 years since the SIPs haven't given return. So I think one, people gain by experience, but the message is always needs to be repeated, and SIP is the best instrument not just for the first time investor but also for a mature investor in this market, because part of the portfolio I think should be through a SIP route, which kind of takes away the emotion that you go through because it's just getting debited from a bank account and you're accumulating units as the time goes by.
Sumendra, ultimately returns are a function of earnings. Earnings are a function of underlying economy. On both the accounts, the news is not great. Underlying economy is slowing down and earnings, well, the drought continues. So what is the pitch for someone who's talking and thinking long term? Because if the long term picture is looking shaky because the underlying current of the economy is changing, then why should one start a SIP? Because what looked like a bull market couple of quarters ago is now smacking of a bear market.
So I think the first thing you should look at is while economy is important in terms of it being the main driver for the underlying companies there, as an investor we should look at is pure earnings, because we are finally slaves of earnings. So it is true that in the last 7-8 years we haven't seen a sustainable, consistent double-digit earnings growth. I think last 10 years it's been around 7%. But as this earnings comes back into the system, that is what is going to be the key driver of the economy as well as for companies. As a fund house, we've been a bottom-up fund house team. So to that extent, the way we build a portfolio and stitch it up is that we try and pick up companies where we see within the sector or within the economy it doing better than the rest. By that I mean that earnings growth should be sustainable and better than the rest. So if I look at the aggregate of stocks that we hold across our portfolios, I think the earnings growth could be high teens. So clearly the market, while is talking of high teen numbers, you have been seeing downgrades come through. Our portfolio, given what numbers we saw in the first quarter, clearly is showing an uptick there. So as long as these earnings play out over the next 9-12 months, one should see we are much better off, because today there is value in a host of areas, given that the prices have corrected, earnings has come about, but not at the pace that we would want it to. And I think a combination of this is actually a lot of value emerging in the market.
Kailash, just for the benefit of our viewers, market return are always a function of what the risk-free return in the system is. you would argue that central bankers are reducing interest rates, and locally the RBI has managed to put the genie of inflation back in the bottle. So at an environment where interest rates are coming low, do you think one should not expect great returns? Because 7% is what you get in the bond market, plus minus 2 or 3%.
So, this is a very good question, and possibly we've tried to answer it a couple of times before. If you look at the historical returns of the stock market, they are around the 14.5%, ever since inception. But if you look at the risk-free return then, it was around 9 to 10% in that range. And if you look at the stock market, it's given a 50% higher return than what the risk-free return is. So if you just extrapolate that and you take it on 7-8% in that range, you're talking about a 12% return going forward. So the expectation from an individual investor should be that if he gets 12%, he should be a happy person, because that's well over what possibly some of the other people or other instruments will deliver. At the same time, anything about 12, whatever he gets, whether he gets 14, 15 or whatever, should be treated like a bonus. Because when you say it is a bonus, you don't really expect it every year. And if somebody goes in with that mindset for 3, 5, 7, 10 years, or depending on his goal, then the chances of that individual investor being disappointed, is really minimal. I think that's a big point of education that we need to do. Currently, we just go by a flat number that last 1 year or last 3 years, the returns have been X, Y, Z, and then the expectations are built at a much higher platform, leading to much higher disappointment. So I think pairing the expectations is very, very important. We need to just ensure that to send that right message in terms of controlling the emotions, which is the most difficult thing to do today. And I think that's something we will continue to keep talking about.
I'm just going to take that point forward for the benefit of our viewers. You're talking about a early teen kind of a recovery for earnings, right? Yeah. Mid-teen, early teens, right?
This year could be an aberration because, given that the corporate banks, which were contributing to the loss side, that
they
makes
suddenly start
that can make it look like, maybe a 17-18% kind of number.
Now, to imagine if the starting point is today,
yeah,
which is about 10,000 plus on the Nifty, I'm just using that for reference purpose. The starting point in terms of a P multiple could be 17-18 times depending on the schemes you're talking about. Can a SIP investor hope for CAGR return, double-digit CAGR return on a 3 to 5 year basis, or that is not going to happen because the starting point is different? Anyone can answer this.
So I think in terms of investing, I think starting point matters the most. And today, as things stand, and if you look at the various areas of the market that have performed, I think you've seen it being too skewed towards only a narrow participation in the market. Beyond that, I think there are a host of opportunities that are available that are neglected because, maybe the economy is not supporting it, companies are good, and the tailwind is not there in its favor. But I think when one stays invested through a cycle, and then if today is the starting point for that cycle, over the next 3 to 5 years, surely I think a double-digit return is a possibility. Given that, you will have earnings growth maybe inch up. You've seen a 7% CAGR in the last few years. With numbers like what we are expecting in the current year come about, I think you could see it moving towards 12-13%, and markets generally track earnings numbers over long periods of time. So I think over the next 3-5 years, one could see a scenario where markets give returns more closer to how the earnings growth has been, and we haven't seen it track the earnings growth for some time now. There was a period when it led the earnings growth before the earnings came through. What is interesting also is in the last 5 years, if you break the period between 2014 and 17, where the mid and small caps did well, actually if you go back and see the earnings growth of that sector was much stronger than the large cap names, and that's why that part of the market did well. We expect similar kind of a rebound come through in the small and mid cap space, and today the opportunity there, or the starting point there, is even more attractive. So given the risk profile of the investor, I think one should know where he should put his money to work.
Today, if some investor walks up to you, say, look, I want to start a SIP, and I genuinely want to start a SIP, but I have limited capital to start a SIP. Should I go the large cap way, which is equity diversified? Should I go to mid cap way? what would be your advice?
So clearly one of the things we need to ascertain is the risk profile of the investor. If he's a first time investor into the stock market per se, either directly or indirectly through mutual fund, then it's better to advise him to a large cap oriented scheme rather than a mid cap oriented scheme. So we need to ask those two questions. Are you willing to take a -20 or a -30 also? Because in a mid cap it is very volatile, but yes, historically they have outperformed the large caps. And that's where I believe today, as if somebody comes and asks me for the recommendation, I would try and convince the person to look at mid and small cap allocation, because it's much sweeter than what it was a year and a half ago.
So it is better to bat on the front foot rather than on the back foot.
Yes, because if you're coming into equities for an incremental risk, I think you should take that call of getting into mid and small cap sector. And given the fact that the last 2 years we've seen a significant erosion in terms of the valuations in this segment, this has become, like Larry just said, has become much more attractive. But you know, talking about a data point, and I love to talk data because that's what really brings out. And I don't believe that data is only historical. It can really become in future. And I'll give you my own example. In '97, I bought a house in Bombay. And I'd bought a house which was a little above my capability. So obviously I was really stretched for finances. And at that time, somebody forced me to invest in a mutual fund. And it was so traumatic because I didn't want to invest, but I was forced to invest. I forgot about it. And those days we didn't have email IDs, PAN numbers or anything like that. And it was in a growth plan. And then like a typical Mumbaite, you change houses. You have not updated the records. You have lost track of the investment. Fast forward to 2012, I remembered there was an investment of that nature. The fund name had changed 3 times. The fund managers had changed 5 times. And that in 15 years then, because 2012 and 1998 end, that was 22 times return. Okay. So the whole reason I give this data point and I love to share this story is, one, it's my story, so it's very believable. Number 2, I think what this teaches us is that if you're willing to take the high and the low, because nobody can time the market. So if you're willing to take the high and the low, you're really willing to go through the motions, you will make decent money, at least more money than possibly what you would make in other competitive investment options. And I think that's the beauty about this product. Apart from it being easy to administer, easy to withdraw money, tax efficient, I think mutual funds really give you that return. And it plays to the best of the ability because we got the best professionals who are fund managers like Larry, who really their full-time job is to understand what the markets do and where to invest and where not to invest.
You know, Samindra, mutual fund story can be summarized in one line: mutual fund sahi hai, right? That's the sum and substance of the message we are trying to take out. Yet I see it is the most complicated way in which people approach investing in mutual funds. They treat equities like Mahalakshmi race course, instant gratification. Why is this habit not changing?
I think that's difficult to understand actually. I think if you look at the investor profile globally too, I think most people talk long term but look at short term returns.
Yeah, it amazes me. You know, we made cars, we made moons, we want to.
It is true across the globe. You know, if you go to see how Japanese investors invest, it's similar. Everybody talks long term, but you know they'll start seeing the navy from the next day. So I think it's hard. I think investor psyche and the fact that you get data on a daily basis, maybe that too is a bit of misleading investors. In a lot of funds where you invest in private equity funds, there is hardly any data available of what you're doing. When you invest in a house, you don't know what the price of the house is on a daily basis. So to that extent, I think availability in the sense that people are tracking it so closely. If you've done your homework well, chosen the fund you would want to invest, the philosophy of the fund house, the people who are running it, the processes, the systems that they have, I think you should be fine. You will have bad years, but over a period of time, I think as long as you stay in a cycle, and this is the thing, people only look at the cycles in halves. So either they have seen an up cycle and they think it will continue forever, they've seen a down cycle and they think this is going to be the way it is. nobody has the patience to be through it through the cycle, and then that's where returns are made. When you're through investments across cycles, that's how capital formation happens.
I think today the entire ecosystem, including media, has really done exceedingly well in saying why SIP is important and why you should stay in the long run. And the good news, and we did a little more data analytics on SIP, and what was strange to figure out is actually the high value SIPs which belong to the HNIs were the ones which actually dropped off. The ones which were the mass affluent and the mass actually stayed on. So when you start dissecting it into above 25,000 rupees, 10,000 to 25,000, 5,000 to 10,000, 3,000 to 5,000, 1,000 to 3,000, the lower you went in terms of denomination, the less was the attrition in terms of stoppages. So clearly we are seeing a maturing market, and that's a very good sign for the future for all of us.
India in a sense has broadband, television, satellite, all the mediums are not very deeply penetrated. But frankly, if I look at the bulk of concentration for SIPs, it's not gone beyond tier 1 cities. It's not gone to tier 2 at all. Even within tier 1, the concentration is within 6 metros, and within 6 metros it is Bombay. Why is that?
So again, has it changed in the last 4 years? The answer is yes.
How big is the change?
Obviously, when you look at it at an AUM basis, it's not very big. But if you look at the new sales basis, you're seeing significant amount of change which is happening. So if the AUM percentage of the big cities still is 90% of the AUM versus 10%, vis-a-vis the new sales maybe at around, I don't have the exact figures, but I think it would be more like a 78, 80, 20. And the interesting part is the more you go into the hinterland, today you don't need to explain SIP.
Okay.
SIP has now become a kind
it's
of
like saying thank you and sorry.
Yeah, they know what SIP is. If I go and say and talk to them of SIP, it's amazing. I can narrate an incident wherein I went to Bhusawal, and Bhusawal is really a small town in Maharashtra. But if I went to Bhusawal and I was surprised at one particular distributor who was only focusing on SIP, and he was saying that he does about 20 to 30 SIPs a month. That's a big number for a place like Bhusawal. So it's a very interesting story that today SIP has become a very acceptable and common name.
Kailash, a very basic question before we wrap. You said that a first timer should start with more like an equity of diversified scheme. It's safe, which means you should keep your choice simple. Yes. But in today's environment, there are more than 24 mutual funds. All mutual funds have variety of schemes. They have unique offerings. Now, for a first timer who is just taking a baby step in a SIP, how do you find out whether your scheme is the best or your peer scheme is best or your scheme is better than your peer? It's a maze. It's a complicated maze. Every mutual fund manager will have some USP. Somebody has 5,000 rupees a month and choice to buy one scheme from one mutual fund.
Yeah, so it's a tough decision, and I think this is where either you need to be that qualified that you need to understand this whole spectrum, or you need to go to a good advisor or a distribution partner who will advise you on this, because they are the ones who are going to do this analysis to give you the right scheme. If you look at real long term, 10 years, 15 years, the big difference between the performing schemes isn't that drastic. Okay, it'll be few percentage points here or there. It's the job to really choose that. But the big mistake which people make is over diversifying into too many schemes. So, we have seen customers with portfolios which are like 15, 20, 30 schemes. Yeah, whereas actually a 6 to 8 kind of a scheme portfolio is a good enough, which means he can choose 2 from one, 2 from another, 3 from one. It's a kind of a mix and match on that. I think today with the information availability online, what you people do through such shows, I think the information is available. I think the discipline needs to come into the picture. And I think that is what is lacking today, the discipline. Because people tend to just look at the immediate past returns and decide the scheme, rather than look at a longer term picture in which how a fund manager has played through cycles and delivered returns. So I think good education or a good advice helps a person choose those 1 or 2 schemes for a first timer. But like I said, a large cap or large cap oriented scheme for a less risk averse investor is always preferable. And just one point before I just talking about, we are talking about disruptions. I believe that technology is going to be the biggest disruption in the growth of this industry. The access which technology provides today on your fingertips, sitting in any remote area, to buy a mutual fund with a few clicks, sell a mutual fund with a few clicks is immense. And what you're going to see is that today we just have about 2 crore investors in the mutual fund industry. I'll not be surprised if in the next 3 to 5 years this number will be in the 8 to 10 crore region. So we have a massive growth ahead of us, and I think we need to just be very happy that we are in the right industry. Like Larry puts his bets on areas which grow, I think people should bet on the mutual fund industry because this is a place where we'll grow.
You don't own a mutual fund
I'll
stock,
just
right?
add something to what Kailash says. So like you said, what is it that an investor should look for? I think it's fairly simple in that sense. Yeah, an investor should look, like I said before, the organization that runs the mutual fund. That will give a lot of a dope of how one should invest. Second is the philosophy that the organization runs. Is it a short-term oriented fund house? Do they chase momentum? Are they value seekers? The third thing is the people. People makes a lot of difference. Yeah, if you know the right kind of people you would want to back. Stay with them through thick and thin. It's not that all fund managers have a great time all through, but they go through cycles too. I think as long as you stick with the right people and have the right processes backing them, I think you'll hit a home run. Yeah.
Kailash, Samendra, fantastic to have you both. I guess the differentiating factor for our viewers here should be that when you're choosing a mutual fund, focus on the word experience, and when you are choosing your financial planning objective, look at the word patience. I guess these are 2 most important takeaways for our viewers. But thank you for joining us, and thank you for tuning in, and thank you for watching Investment Ki Paathshala.